One more question. Company A acquires 100% of the equity and voting rights of Company Q, which owns three investment properties. The properties are multi-tenant residential condominiums subject to short-term rental agreements that oblige Company Q to provide substantial maintenance and security service, which are outsourced with specialist providers. Now, first understand what is this business. This owns three investment property. These are multi-tenant residential condominiums subject to short-term rental agreement. And Company Q provides substantial maintenance and security service, which are provided to specialist providers. Then Company Q has 5 employees also who deal directly with the tenants and with the outsourced contractors to resolve any non-routine security or maintenance requirement. These employees are involved in a variety of lease management tasks like identification and selection of tenant, lease negotiation, rent reviews, and marketing activities to maximize the quality of tenant and the rental income. Is activity of Q Limited qualified to be a business? Now here they are not actually producing anything, but yes, they are providing service. So will this activity be called a business? Yes, the answer is yes. These activities will also be coming under the definition of business because there is input. These residential buildings are input. And you have a team of people who manage this entire thing. That is a process. And the output is the service, rental service, and the income that you generate out of it. So write down quickly. In this case, Company Q consists of a group of revenue generating assets. Company Q consists of a group of revenue generating assets together with employees and activities that clearly go beyond activities ancillary to the properties and their tenancy agreement. The assets and activities are clearly integrated. So Company Q is considered a business. And then if you want, you can draw this diagram. There is input, there is a process, the whole negotiation, marketing, reviewing is process, and there is an output, the service. Done. Input, process, output. One more question. Company S is a manufacturer of a wide range of products. The company's payroll and accounting system is managed as a separate cost center. Now, what is this payroll and accounting system? That means they are not very important as far as the definition of business is concerned. Right? Definition of business is concerned. They are important. Unless you provide an outsourcing of payroll work, outsourcing of accounting work, in-house payroll and accounting system will not be treated as something which generates output, okay, or something worth output. Supporting all the operating segments and the head office function, company A agrees to acquire the trade, assets, liabilities, and workforce of the operating segments of the company, yes, but does not acquire the payroll and accounting cost center or any head office functions. Company A is a competitor of company S. Can company A account for the acquisition as a business combination? It has acquired everything except payroll and accounting system and some head office function. So can we account for this acquisition under IFRS 3? The answer is yes, because what you acquired is a set of integrated activities. Some assets not acquired will not change your accounting. Okay, still it will be called as a business combination. And normally, if accounting, payroll, HR functions are not acquired, which can be easily outsourced from others, or which you can have your own system for that, still it will be called as a business. So in this case, write down, in this case, the activities and assets, in this case, the activities and assets within the operating segments, activities and assets within the operating segments are capable of being managed, as a business, are capable of being managed as a business, and so company A accounts for the acquisition as a business combination. So you have to see what you have acquired. Will that portion be treated as a business? Can that be treated as a business? Does it have input, process, and output? The answer is yes. This payroll and accounting system, what you can do, you can have your own payroll and accounting system which you can merge with what you have acquired, or you can easily outsource it. So that means your activity will not get affected because you have not acquired payroll and accounting cost system. So payroll and accounting cost center and administrative head office function and administrative head office function are typically not used to create outputs, and so are generally not considered an essential element, in assessment of whether an integrated set of activities and assets is a business. Whether an integrated set of activities and assets is a business. Now, one more interesting question. Shell company. What is shell company? Dummy company. Only for the namesake, they have created a company either to get some tax advantage or some other benefit. But really, these don't do anything. Okay? And these shell companies are in the news also for good or bad reasons. In India, it has been observed there are lakhs of shell companies which are promoted for tax benefit, or they don't want to pay employee gratuity PF, so create companies and split the employees into 100 companies so that you don't have to pay so many labor cost, so many other type of cost you can save. So these are shell companies. Now let us see whether acquisition of a shell company will come under this standard. Company A is a property development company and with a number of subsidiary company, each of which hold a single development. So one project, one subsidiary. Okay. So that instead of selling the land and building, you can simply sell the shares. Effect is the same. If I transfer 100% share to you of a company which owns the land, you have actually acquired the land. After completion of the development, company A sells its equity investment because the applicable tax rate is lower than that applicable to the sale of the underlying property. Okay. See, businessmen are so smart. Company A is planning to start the development of a large new retail complex. Rather than incorporating a new company, Company A acquires the entire share capital of a shell company. It just acquires a company which is not doing any business. Okay. Does this shell company qualify to a business? And will IFRS 3 be applicable? Yes. The shell company is not doing anything. They just hold the property in their name. It is just a property registered in the name of that company. Okay. And in this example, company is planning to start the development of a large new retail complex. Rather than incorporating a new company, it acquires the entire share capital of a shell company only. It's not a business. It is just an asset you have acquired. Does this shell company qualify to business? Now they have not yet done anything. They will first acquire and then they will develop it. So it is more like an asset acquisition. So will IFRS 3 be applicable? So the answer is no. For this example, the shell company does not contain an integrated set of activities. It is basically you have acquired land only. It seems you have acquired a company, but substance over form is that you have acquired the land and then on that land you will do the development activities. The shell company does not contain an integrated set of activities and assets and so does not constitute a business. So consequently, company A should account for the purchase of the shell company in the same way as the incorporation of a new subsidiary. In the CFS, Consolidated Financial Statement, I will say CFS, any cost incurred will be accounted for. Any cost incurred will be accounted for in accordance with their nature and applicable IFRS. Any cost incurred will be accounted for in accordance with their nature and applicable IFRS. And next thing is that this is one different treatment. If it is a business combination, usually cost incurred are charged to P&L account, which we will see later, accounting part. If it is business combination, goodwill is recognized if there is a goodwill. But in this example, goodwill will not be recognized. Now one more interesting example, good news. You don't have to write. Company A is a pharmaceutical company. Since its inception, the company had been conducting in-house R&D activities. Underline. Again, practically, this is now what is happening a lot in real life. Many companies have very high-tech R&D facilities, okay? And which are later on acquired by other big business houses. Which are later on acquired by other big business houses. Okay? Because you are engineer, you are scientist, but you don't have business acumen or business skill. So you create R&D facilities, which later on is taken by big corporate giants. And through its skilled workforce and recently obtained an IPR in the form of patent over certain drugs. Company has a production plant that has recently obtained regulatory approval. However, the company has not earned any revenue so far and does not have any customer contract for sale of goods. B acquires A. Does company A constitute a business? This is similar to development stage entity, but at least there the company had a contract with customer to start selling product. This question goes one step further. Till now you don't have any contract for sale of goods. Of course, you have a input, process, and a plant which has a capability of generating the output. Whether this R&D activities can be treated as business. Yes, yes. So write down. It is written. The business requires existence of input processes. Sometimes output may not be necessary condition as long as you have the ability to generate the output. In this case, the skilled workforce, manufacturing plant and IPR. What is this three items? Input along with strategic and operational processes constitute the input and process in line with requirement of IFRS 3. When the said input and out processes are applied as an integrated set, the company will be able to produce output. And then we have already discussed that even if the company currently does not generate revenue, okay, it is still business as per IFRS 3. Basis that and presuming that company A would have been able to obtain access to customer that will produce the output. So we will assume that company A will be able to generate revenue. The present case is said to constitute a business. One more question. Again, good news. Answer is printed. Modifying the above illustration, if company A had revenue contracts and a sales force such that company B acquires all the input and processes other than the sales force. So this is one similar example we had taken. Accounting and payroll function was not taken over. Then whether the definition of business is met if suppose you do not take over the sales force, but all other assets you have taken over, processes you have taken over, will it still be classified as a business? The answer is yes. Because you can easily replicate the sales force, either in-house or outsourced. So sales force has not been taken over. However, if the missing input can be easily replicated or obtained by the market participant to generate output, it may be concluded that company A has acquired the business. Further, if company B is also into similar line of business, then the existing sales force of company B may also be relevant to mitigate the missing input. Therefore, it continues to remain business as per IFRS 3 and the standard would apply. Next question is dealing with buying controlling stake in a running business. X is a garment manufacturer and has been in operation for last 10 years. The company produces a wide range of garments and employs workforce of designer, machine operator, quality checker and other operational, marketing and administrative staff. So that means it has input and process. It owns and operates a factory, warehouse, machinery and holds raw material inventory and to finished product. So at least you must have got convinced that this is a business. Then on 1st April, A Limited paid 30 crore to acquire 100% of the ordinary voting shares of X Limited. No other type of shares has been issued by X Limited. Whether this will constitute a business combination as per IFRS 3. So in this case, we have acquired the shares of that company. Even that is covered by the standard. Okay. And then first you will apply this standard and later on at the end of the reporting period, we will prepare consolidated financial statement. So you can acquire control by acquiring shares also if it gives you control. In this case, because this is a business and you have acquired the control, that is what I have to prove in every problem, that what I have acquired is a business and I have got the control over that business. If these two things you can prove, then IFRS 3 is applicable. So write down, in this case it is clear that X Limited is a business. It is clear that X Limited is a business. It operates a trade with a variety of assets. It operates a trade with variety of assets that are used by its employees, in a number of related activities. These assets and activities are necessarily integrated. These assets and activities are necessarily integrated in order to create and sell the company's products. So first thing, in the first paragraph you prove it is a business, and then in second paragraph you demonstrate you have acquired the control. The acquisition of shares of X Limited by A Limited to obtain control on 1/4/15 is acquisition of a business. Now if you want to draw this diagram you can, otherwise you can leave it. Now what you have to demonstrate, there is an input which in this example is workforce of designer, machine operator, quality checker. Process, that is manufacturing, and output, that is the garment. So what we have done in the last about half an hour is we have taken different case studies to identify whether it is a business and business combination or not. So in some example the answers were yes, in some example the answer was no. If all the three are present, business. If output may not be present but it has a capability of generating output, then also it can be a business. Now what is the method of accounting they have suggested in IFRS 3? To this they have given a name called acquisition method of accounting. Acquisition method of accounting. Like in IS 28, which you will study soon, the name of the method is equity method of accounting. Equity method of accounting, you will learn that only the carrying amount of investment is adjusted. In acquisition method, we acquire the assets and liabilities of the entities over which we have control. Okay. And on the date of acquisition, if there is a difference between the consideration paid and the net identifiable asset acquired, that will be treated as goodwill. In some rare cases, it can be a loss, gain or loss. Gain is when you pay more is goodwill. The other one is called gain on bargain purchase. Gain on bargain purchase, which is transferred to profit and loss account. No capital reserve in this chapter. This concept of capital reserve is there in Ind AS, okay, followed by Indian companies. But in global standards, the concept of capital reserve does not exist. That is only Indian creativity, capital reserve. Okay, to my knowledge, this capital reserve does not exist in other gaps like US GAAP or IFRS. So either it is goodwill or gain on bargain purchase, which will be transferred to profit and loss account. So with that discussion, we will follow these 6 steps to do the acquisition accounting. Okay. So what are these 6 steps? Step 1, identify the acquirer. Step 2, identify the acquisition date. Step 3, identify and measure the consideration transferred. Step 4, recognize and measure the identifiable asset acquired and liabilities assumed. Step 5, recognize and measure non-controlling interest in the acquiree. And step number 6, recognizing and measuring goodwill or a gain from bargain purchase. Goodwill means when you pay more than what you have received. Gain from bargain purchase when you pay less than what you have received. So it's a gain. Okay. You got more asset, you paid less consideration. So these are the 6 steps. Okay. So click identified acquirer. Identify acquirer. Why we need to identify an acquirer? This standard is applicable only in the books of acquirer as per IFRS 3. Okay. So the one who is acquirer, he will apply IFRS 3. Which means the one who obtains control. One who obtains control. So all business combination will be accounted under acquisition method. Point number 2, that the acquirer is the party who obtains control of another entity. The control is defined in IFRS 10, which means you have the power to direct the relevant activities of the acquiree. Then you have acquired the control. Control gives you power to direct the relevant activities. And the entity on whom the control is established is called acquiree. The word control will be explained to you in IFRS 10 in more detail. In this chapter also we'll discuss, but briefly. It may also so happen that guidance in IFRS does not clearly indicate which of the combining entity is the acquirer. Sometimes there can be confusion. Who is the acquirer? Then first you apply the guideline given in IFRS 10, and sometime IFRS 3 provides additional guidance on identifying the acquirer. So to put it in simple terms, the one who obtains control is the acquirer. So now we will discuss some paragraph which are actually taken from IFRS 10. Because in order to identify acquirer in this chapter, I need to know the meaning of control in IFRS 10. So what is a control? What is control? What gives rise to control? An investor controls an investee if and only if the investor has the following. So underline these 3 points. Control means one has to see that you have the power over the investee. Power means power to direct the relevant activities. Relevant activities means your operational and financial activities. Okay, those activities which will affect your return is called relevant activities. So you have the power to direct the relevant activities like sale, purchase, manufacturing, okay, employees related decision, dividend related decision. So that is the power. And this entity has exposure or rights to variable return from its involvement with the investee. Variable return means your return can vary as the performance of the other entity, that is the acquiree, would vary. Like for example, dividend income. Dividend income of the acquirer may vary as the income of the acquiree will vary. So you are not getting a fixed return here. Your returns are variable. It will vary as the investee's performance would vary. Third, you should not only have the power, you should have the ability to use its power over the investee to affect the amount of the investor's return. That is why I said in the beginning somewhere, 50% is not a necessary criteria in this standard. If you have 40% share in the company, but you are able to use your power, direct the relevant activities, and make an impact on the return, then it means you have the control. First point, power over the investee. Second, exposure to variable return. And third point is ability to use the power so that you can affect the investor's return. All these 3 terms, if you see, may have some subjectivity involved. And sometimes there may be more than one person who have all these powers. Then you have to really sit down and check who is the acquirer. Some person may have more than 50% share in voting power. Some person may have majority in the board. Okay. So this way you have to really work and check who is the power. But generally you are able to identify, generally in most cases. Like for example, indicator of control. So this is the best indicator for you as a student. The entity which holds more than 50% share in voting right. The entity which holds more than 50% share in voting right is the best example of control as far as you are concerned. Because if you have more than 50% share in voting power, you can take most of the decisions which require simple majority. Yes or no? Which are the decisions which are requiring simple majority in a company? Declaration of dividend, appointment of auditor, and there are so many, right? Which are important decisions, but it only requires a simple majority. Then second, you have the power to appoint or remove board of directors. Now, why board of directors is linked here? Board is the decision making body, the highest decision making body. If you can control the board, you are actually controlling the company. Is it right? You don't need to control thousands of employees. You just need to control the board. A corporate works like a Indian parliament. You just need to control the council of minister. And then you run the government. Is it right? And then investors have the third way to identify control. Investors have exercisable potential rights voting currently. Now the standard goes one step beyond other standards like our accounting standard 21. While checking control, not only the actual shares which have been issued are considered, but it also considers potential voting rights shares which can be exercised currently. Potential voting rights share which can be exercised currently. It means, suppose you have an option to buy the share of the company, and after considering that option to buy the shares of the company, your stake exceeds 50%. Your existing stake plus your shares, potential right shares, which you can exercise currently, means you can exercise. If it's subject to 1 year waiting period or something, then you don't consider that. Currently means now you can exercise it. Okay. And considering that if your stake exceeds 50%, including the potential voting share right, then also one can presume control. And one example on that we have mentioned here, where not only your existing voting right, but your potential voting rights are also taken into account in determining the control. Ready for this interesting case study number 10. Company P Limited, a manufacturer of textile products, acquires 40,000 of equity shares of Company X out of 1 lakh shares in issue. Okay, so P Limited acquired 40,000 shares and total number of shares 1 lakh. As a part of the same agreement, Company P purchases an option to acquire additional 25,000 shares. So this is an option to buy 25,000 share. When you have actual 40,000 share, this option is exercisable at any time in next 12 months. So is it currently exercisable? Yes. Today also you can exercise. The exercise price includes a small premium to the market price at the transaction date. It means the exercise price is greater than market price. So technically calling this is an out of money, because it's a call option, option to buy, but still the premium amount is very small. So therefore it can be ignored. Okay. So it is assumed that you will exercise it. It is assumed that you can exercise your option, because by exercising the option you are getting 25,000 share which will give you a control. Right now you see on the screen your share is 40% if you look at this number, but if I add this 25,000, so your total shareholding will become 65, and this is 1,25,000, so it will exceed that 50% now mark. So don't you think you would be happy to exercise your option, even though the exercise price is more than market price? After the above transaction, the shareholding of company P's two other shareholder are 35,000 and 25,000. There are two more shareholder, so which I will call shareholder number 1, shareholder number 2. So this is their present actual shareholding, 40, 35, 25. Each of the shareholders also has currently exercisable option of 2,000 each. Oh, so they also have an option. So my total number of share in that case will become 1,29,000. So considering potential shares, these are the number of shares they have. 65 divided by considering all potential share, still it is more than 50% share. So then the question will arise whether P Limited controls that X Limited. Is it right? Sorry, whether X Limited controls, no, who is the acquirer? P. Okay, whether P controls X. Question, write down whether P controls X. So the answer is, in assessing whether it has obtained control over company X, company P should consider not only 40,000 shares it owns, but also its option to acquire another 25,000 shares. In this assessment, the specific terms and condition of option agreement and other factors will be considered. In this problem, the options are currently exercisable, and important underline, there are no other required conditions before such options can be exercised. It means you can exercise it today only. Pay the amount, get the shares. If exercised, this option would increase company's ownership to controlling interest of over 50%, and before considering other shareholders' potential voting right. If I also include the other shareholders' potential voting right, still company P will enjoy a majority. 65 out of 129 is more than 50% share. The premium included in the exercise price makes the option out of money. However, the fact that premium is small and the option could confer majority ownership indicates that potential voting rights have economic substance. Is it right? See, for a small premium, if you are getting control, you will be willing to pay for it. By considering all the above factors, P concludes that with acquisition of 40,000 shares together with potential voting right, it has obtained control of company X. Welcome to IFRS 3 if you have obtained control over company X. Premium would have been very high. Yes, so then you have to think whether with that high premium it will be willing to acquire 25,000 shares or not. If the answer is no, then with 40% prima facie I don't have control unless there is other way you can demonstrate the control. So premium, if it is very high, then it is as good as you are not going to exercise that option. Now, paragraph 8, acquisition through payment of cash or incurring of liability. This is usually the way business combinations are executed. Pay the cash, take the net asset, tata, bye bye. Okay. Or in case if you don't want to pay cash immediately, you can pay it later. So that we will call in this chapter deferred consideration. Okay. That means the amount will be paid over a period of time, because sometimes the amount is very, very high. In some business deals, it goes into tens of thousands of crores, and therefore they spread it over some 3 years, 5 years. So that is business combination through cash or incurring of liability. In a business combination effected primarily by transferring cash or other assets or by incurring liabilities, the acquirer is usually the entity that transfers cash or other assets or incurs the liability. This is one more way of identifying the acquirer. Who is the acquirer? These are indicators of who is the acquirer. The one who pays consideration. The one who pays consideration in the form of either cash or other assets or incurs a liability. Next model of identifying acquirer is the one who issues. The one who issues equity shares of its company, equity instruments. So we have seen different ways. One is through control over board of directors, control over voting rights, existing voting right plus potential voting right, the one who pays consideration, the one who issues equity instrument. So generally the one who issues equity, I have used the word generally, will be called acquirer, but not always. Sometimes the one who issues share is acquiree, and the one who to whom shares are issued becomes the acquirer. This situation is called reverse acquisition. What is reverse acquisition? We will discuss after 2-3 paragraphs. Okay, so just wait for instruction. So one topic to be discussed today in theory and then later as numerical question also on that. Okay, which is called reverse acquisition accounting. Which are the other facts and circumstances to be considered in determination of the acquirer? So other facts and circumstances shall also be considered in identifying the acquirer in a business combination affected by exchanging the equity interest. Now in the next paragraph number, I think 9 only, there are some examples given, situations given, and these situations are indicators of who is the acquirer. But one has to examine all facts and circumstances together and then come to a conclusion who is the acquirer. These are the indicators. One, the acquirer is the combined entity whose owners have the ability to elect, appoint, or remove majority of the board of directors. So most probably this will be the acquirer because you are controlling the board. You can appoint, you can remove the board. Next indicator is the entity. The acquirer is the combining entity whose management dominates the management of the combined entity. So whose management dominates the management of combined entity? You have more board members than the others. And this is also very practical. Sometimes when two or more companies come together, and then we have to find out who is the acquirer, who has got more members on the board. Okay. Same like Indian Parliament. Who is the ruling party? The one who has more member. The acquirer is the combining entity that pays a premium over the pre-combination fair value of the equity interest of other combining entity. This is another good indicator of control. The one who pays premium to acquire the equity shares of other entity. And fourth is the acquirer is combining entity whose relative size is significantly greater than that of other combining entities. But this indicator may not always be foolproof. Okay, one has to really see the entire calculations, number of share and everything, then decide. But normally it is found a bigger entity is the acquirer, smaller entities are acquiree, because the bigger entity will get the major chunk of the shares of that company. They'll get maximum board members in that company. They will have maximum domination in different management teams. And then I have written a comment in the last point on the screen. The identification of acquirer is significant. It is in the books of acquirer that business combination will be accounted as per this standard. Now we are going to solve 2-3 examples, 11, 12, where we will check who is the acquirer. Many times it is simple, sometimes it may be complicated also. And in a reverse acquisition, you have to be little more careful. So 11 number, company and B operate in power industry and both entities are operating entities. Company A has much larger scale of operation than B. Company B merges with company A such that the shareholder of company B would receive one equity share of company A for every one share held in company B. Such issue of share would comprise 20% of the issued share capital of the combined entity. After discharge of purchase consideration, the pre-merger shareholder of A hold 80% of the capital in company A. Who is the acquirer? This is a very obvious answer. A holds 80% of the capital. So in this entity, there are two types of shareholders. Shareholders of A and shareholders of B. Shareholders of A holds 80% share and the shareholders of B would hold 20% in this. So who would be the acquirer here? A. Prima facie, for all reasons, A would be the acquirer. The answer is printed. Read as homework. One more example. Question number 12. Company A decided to spin off. Spin off means to remove, okay, to separate. Right now they are forming part of this entity. They want to separate into a different entity. Spin off two of the existing business currently housed in two separate entities, Company B and Company C. So this is a group. In this group, the parent is A and there are two subsidiaries B and C. To facilitate the spin-off, Company A incorporates a new entity, that is Company D, with nominal equity and appoints independent directors to the board of Company D. So first it just incorporates a company with a small minimum share capital that is required to form a company. And who is appointed on the board? Independent directors. Company D signs an agreement to purchase Company B and C in cash, conditional on obtaining sufficient funding. To fund these acquisitions, Company D issues a prospectus offering to issue shares for cash. Now this Company D needs money so that it can acquire B and C. Who will supply the funds? At the conclusion of the transaction, Company D is owned by 99% owned by new investors, with Company A retaining only 1% of the non-controlling interest. That 1%, that initial share capital they have put in. In this situation, a set of new investor paid cash to obtain control of Company D in an arm's length transaction. So who is the owner of D? The new investor. And this money Company D is using to effect the acquisition of 100% ownership of B and C. D raised money from outside investors, not from A, and then used that money to acquire 100% of B and C. So now the question is, who is the acquirer? Okay, who is the acquirer? The Company A relinquishes the control over Company B and C to the new owners of Company D. Although Company D is a newly formed entity, the question was whether a newly formed entity can also be in the acquirer. The answer is yes. As the acquirer, not only because it paid cash, but also because the new owners of Company D have control over Company B and C from Company A. So they have actually purchased the shares of Company A. Shares from Company A by paying cash. So A has lost the control and D has acquired the control. Now we'll have some small discussion on reverse acquisition today. Problems we will take later. Okay. So this is a very interesting issue, reverse acquisition. A Limited and B Limited are two companies. A has 10,000 shares, B has 10,000 shares. A acquires B. A acquires B and it issues shares in the ratio of 10:1. Who issues shares to whom? A issues shares to B in the ratio of 10:1. So how many shares it will issue to B? 10 into 1, 10,000. 1 lakh share will be issued to B. The total number of shares is 1,10,000. So in the eyes of law, A is called legal acquirer. Legal acquirer. A has to perform all the legal formalities to acquire B. Okay. But now if I look at the shareholding percentage, in this new company, total 1,10,000 shares are there. 10,000 shares are held by shareholders of A. 1 lakh shares are held by shareholders of B. So who has the control in this entity now? B shareholder will have entity. So B is called accounting acquirer. Even though shares are issued by A, but B will be called accounting acquirer. Is it right? So A will be called legal acquirer, B will be called accounting acquirer. A will be called accounting acquiree and B will be called legal acquiree. So how does it matter? It matters because normally the assets and liability of the acquiree are measured at fair value. Assets and liability taken over from the acquiree will be measured at fair value. Now in this case, A is legal acquirer, but accounting acquiree. So even though we are accounting in the books of A, we are going to do the fair valuation of A's assets and liabilities rather than B. That is the accounting impact, but that we'll discuss later. I will give you journal entries also. So A's assets and liabilities will be fair valued, okay, rather than B. So some complication are involved in this type of problem. We'll discuss when we'll come to accounting part. So now read the theory. Reverse acquisition occurs when the entity that issues securities, that is called legal acquirer, is identified as acquiree for accounting purpose. So in my previous example, A is legal acquirer but accounting acquiree. The entity whose interests are acquired, so he is technically legal acquiree in the eyes of law, but he is an accounting acquirer for accounting purpose, and this kind of transaction is called reverse acquisition. For example, now why would companies do such kind of things? Suppose there is a private company and it wants to be a public company, but it does not want to register its equity shares also. So they will identify some existing listed company, but which is a poor company, okay, not too good, but listed. So now you enter into a deal in such a manner, they give you so much share that you actually start controlling that publicly listed company. This is called backdoor listing, okay, backdoor listing. So you are fooling the regulatory agencies because you are not suppose capable or qualify for listing, as you will study in your law subject, listing obligation and disclosure requirement, LODR, that you have to comply with some regulations which you don't want to or you are not qualified to, then you do this activity. So to accomplish that, private entity will arrange for a public entity to acquire its equity interest in exchange for equity interest of the public entity. But in this process, the shareholding is designed in such a manner that ultimately it is the private entity who will start controlling the public entity. So the legal acquirer will be public entity because it issues the share, and private entity would be legal acquiree. But for accounting purpose, there will be a role reversal. Public entity will become accounting acquiree and private entity will become accounting acquirer. Okay. The accounting acquiree must meet the definition of business. So in order to apply this standard, one condition is always applicable. It should be a business. The accounting acquiree must meet the definition of business for the purpose of recording the transaction in as reverse transaction. Okay. Now there is a small example also. We'll read it quickly. and the answer is also printed. Company A and B operate in power industry. Both entities are operating entities. Company A has much smaller scale of operation than B. B merges with A such that shareholders of B would receive 10 equity share for every 1 share in B. Such issue of share would comprise 70% of the issued share capital of combined entity. Understood? So this time the share exchange ratio is designed as 10:1 in favor of B. So B's shareholder will hold 70% of the share capital of the combined entity. So who is the legal acquirer? A. But who is the accounting acquirer? B. Okay. So now we will continue tomorrow.